Hello, my name is Joe Hoyle speaking to you from the University of Richmond. Welcome to Chapter 5. Chapter 5 is a continuation of Chapter 4. They fit together. In Chapter 4, we talked about the 4 steps to take transactions and produce financial statements. And those 4 steps were to analyze the transaction, to record the debits and credits from that transaction, to adjust those accounts, and to report those accounts. We talked about the first 2 of those steps, analyze and record. Here in Chapter 5, we will continue by looking at adjustments and then the actual reporting process as we create financial statements. Why do we need adjustments? Well, transactions, as you learned in Chapter 4, are events that have a financial impact on a company. They have to be analyzed and recorded. However, other changes take place because of the passage of time. There are no real events. They're merely things that change because time passes. So when a company gets ready to produce a set of financial statements, they need to look at all of their accounts, and they typically do this by creating a trial balance and then decide whether any of those accounts have changed because of the passage of time. And almost without exception, some of the accounts will change because time has passed. Here in Chapter 5, we're going to look at 4 different types of accounts that typically have to be recorded or at least changed because of time. And those are accrued expenses, prepaid expenses, accrued revenues, and unearned revenues. Those make up a fairly good percentage of the adjustments that most companies need to make prior to producing financial statements. Keep in mind that the adjustments are necessary so that the information being presented will be fairly presented. Let's talk a bit about those 4 types of adjustments. Since this makes up such a large part of this chapter, I want you to look into this with the idea that this will help you understand the reading. Accrued expenses. The word accrued means to grow. So therefore, an accrued expense is one that grows up over time. For example, you hire employees and you're going to pay them a salary at the end of the month. The amount that you owe them, the salary expense that you owe them, will grow up literally one day at a time as they work for you. That is an accrued expense. So, when you get ready to prepare financial statements and you're ready to make the adjustments, you typically look for any accrued expenses so that they can be recorded so that your accounts will be fairly presented. Salary is the primary example, but interest, insurance, advertising, all are expenses that can accrue, that can grow up over time. Before preparing financial statements, always make sure that the accrued expenses have been recognized. Second, prepaid expenses. As the name says, prepaid expenses means that you have paid for these in advance. Remember that an asset has future economic benefit, whereas an expense will have past economic benefit. A prepaid expense is an asset. It will give you a benefit in the future. You often, for example, will prepay rent so that you can use a building or equipment in the future. Initially, that prepayment is recorded as an asset. Prepaid rent, possibly prepaid insurance. But then, as time passes, and as that facility is used to generate revenue, that future value becomes a past value. So, over time, you have to take that asset and gradually turn it into an expense. Whenever you're ready to prepare financial statements, whenever you're ready to make your adjustments, you typically look at any prepaid expenses to see if they have already become actual expenses. If so, you need to make that adjustment. Accrued revenue. Again, there's that word, accrued. Then this is a revenue that grows up over time. Let's assume that you're doing something for a client. As you do the work, you're earning the revenue. But if you only do a little bit at a time, often you don't record that because it's just too much trouble. So, when you get ready to prepare your financial statements, you will stop, you will look at the trial balance, and you will look for any revenues that have grown up, that have accrued, but have not yet been recorded. And once again, they will be recorded through the adjusting process. And finally, of our 4 examples, we have unearned revenues. Occasionally, you will receive money before you do any work. Some jobs just require payments in advance. In those cases, when you get the money, there has been no earning process. So that is recorded as a liability. An unearned revenue, which we sometimes call a deferred revenue. But you will do the work, and when you do that work, that unearned revenue has to be changed into a regular earned revenue. When you're making the financial statements, you look for any unearned revenues where the earning process is now substantially completed so that you can switch that unearned revenue, that liability, to a real revenue and increase your net income. Once the adjustments have been made, like a journal entry, they will be posted into the ledger accounts. The T accounts do need to be fairly presented. So every one of the adjustments, just like every journal entry, is posted into the appropriate T accounts. From those T accounts, you can then produce your financial statements. The income statement is produced first. And as we've seen before, it will have the revenues, the expenses, the gains, and the losses for the most recent period of time. That will give you the net income reported by that company. Second, you have the statement of retained earnings. The beginning retained earnings balance plus the income for this year less any dividends that were paid to your owners this year. Remember, retained earnings is all of the income that the company has earned since it first began, less all of the dividends paid to the stockholders. Third, you have your balance sheet. You list all of your assets, your cash, your prepaid rent, your equipment, your land, your inventory, all of the assets, all of those things that have future economic benefit. In addition, you list all of your liabilities, accounts payable, rent payable, salary payable, notes payable. And finally, you have your third section, stockholders' equity, which so far only has 2 things in it. Capital stock, the contributed capital that the owners have put into the business, and the retained earnings. We'll see more in stockholders' equity a little bit later in this textbook. And finally, you have your statement of cash flows. It is the one statement that doesn't come directly from the T account balances. Instead, it is an explanation of the changes in the cash account. And as we said before, it is made up of 3 sections: operating activities, investing activities, financing activities. Chapter 5 is the completion of Chapter 4. We have now started with transactions. We have analyzed them, we have recorded them, and then here in Chapter 5 we have adjusted them for any changes because of the passage of time, and then we have taken those adjusted balances and we have used them to produce financial statements. You are well on your way to gaining an excellent knowledge of financial accounting. Go read Chapter 5, and I think now that we've gone through it together, it will make a lot of sense, and you'll be able to increase your knowledge even further.